Hey everyone, welcome back to Corporate Decoder. Today, the advisors Inner Circle Fund just filed a Form N-CSR shareholder report, and I'm seeing some important corrections that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is telling us about some smaller errors in their last report, mostly about accountant fees. Let's break down what that actually means for the fund and the investors. So right off the bat, this filing is an amendment, meaning they are correcting their previous report. The big reason here is a misstatement about what they paid PricewaterhouseCoopers LLP or PwC for their services. This happened for the fiscal year that ended in October of 2025. They want us to know that the numbers for the year before that, ending in October 2024, were correct and are not changing. This is essentially a do-over on a specific part of their financial picture. This brings us to the actual shareholder report itself, which is attached here. This is the core information that they sent out to the people who own shares in the fund. It tells them how the fund has been performing. This filing covers at least two different classes of shares within the L.S.V.V.X Conservative Value Equity Fund. We have institutional class shares which have the ticker symbol L.S.V.V.X and investor class shares which trade under L.V.A.V.X. Both are reporting for the period from the 1st of November 2024 to the 31st of October 2025. Let's look at how much it costs to invest for a hypothetical $10,000 investment in the institutional class shares. The costs for the last year were just $37 or 0.35%. For the investor class shares, it was a bit higher at $64 or 0.60%. This is actually quite low, which is good for shareholders because more of their money is working for them. Now for the performance, the broader US stock market measured by the S&P 500 index did quite well, gaining 21.45% by the end of October 2025. But it was a bit of a mixed bag. Big tech companies and growth stocks really led the way, while smaller companies and what are called value stocks companies that look cheap compared to their earnings or assets lagged behind. The Russell 1000 index, which tracks larger companies, was up 21.14%, while the Russell 2000 for smaller companies only gained 14.41%. Style-wise, value was way behind growth, with the Russell 1000 Value Index rising only 11.15% compared to a huge 30.53% jump for the Russell 1000 Growth Index. Within this environment, the L.S.V.V.X Conservative Value Equity Fund institutional class managed to gain 12.99%. That is a solid return, but it did underperform the overall market. The report explains this by saying the fund's focus on deeper value, meaning stocks that are really cheap caused it to lag when growth stocks were booming. Stock selection did contribute positively though, especially in healthcare, financials, and information technology. The investor class shares also did well, gaining 12.75%. Again, a good return, but not quite keeping pace with the broader market's explosive growth driven by tech. Looking at the longer term from October 2015 to October 2025, a hypothetical $100,000 investment in the institutional class shares grew to over $260,000. That is a pretty impressive return over a decade. The investor class shares would have turned $10,000 into around $25,000 over the same 10-year period, showing consistent growth. Let's look at average annual returns for the last year. Institutional class returned 12.99% and investor class returned 12.75%. Over 5 years, the institutional class averaged 16.85% and the investor class averaged 16.57%. And over 10 years, institutional class averaged 10.07% and investor class averaged 9.79%. These are strong numbers, especially considering they are value-focused funds in a market that has recently favored growth. As of the 31st of October 2025, the fund had $134,373,000 in total net assets. It held 201 different investments. The total advisory fees paid were $230,000, and the portfolio turnover rate was 25%, which means they bought and sold about a quarter of their holdings during the year. This turnover rate is relatively low, suggesting a more buy and hold strategy, which can be good for reducing trading costs. Looking at where the fund puts its money, financials are the largest sector at 24.0%. Healthcare is next at 14.6%, followed by information technology at 12.3%, and communication services at 9.1%. The fact that financials and healthcare are the biggest holdings really aligns with a value investing strategy, as these sectors often have companies that trade at lower multiples. The top 10 holdings give us a good snapshot of the fund's core bets. JPM Chase is the biggest at 3.1%, followed by Alphabet Class A at 2.6%, and Berkshire Hathaway Class B also at 2.6%. Other big names include ExxonMobil, Johnson & Johnson, Amazon.com, Wells Fargo, Cisco Systems. Micron Technology, and Bank of America. It is a mix of large, well-established companies, which makes sense for a fund focused on value. They explicitly state there were no material changes during the reporting period. This means no major shifts in strategy or structure, and importantly, they confirm there were no changes in or disagreements with their accountants. This reinforces that the accounting side of things has been stable, apart from the correction noted earlier. Now, let's talk about who is overseeing the financial reporting. The board has an audit committee financial expert, and that person is Robert Mulhall. He is considered independent, which is crucial for ensuring objective oversight. This is where we get into the details of what they paid their accountants, and it ties back to that initial correction. For the fiscal year ending the 31st of October 2025, PricewaterhouseCoopers LAP or PwC billed $96,175 for audit fees. For tax fees, which were described as services to service affiliates, that number jumps significantly to $682,400. For the year before, ending the 31st of October 2024, PwC billed $91,274 for audit fees. No tax fees were listed for service affiliates in that year. Then we have Ernst & Young LLP, or E&Y. They billed a much larger amount for audit fees, $587,404 for 2025 and $539,063 for 2024. No other fees were listed for E&Y. We also see Cohen & Company, who billed $45,800 for audit fees in 2025 and $43,700 in 2024. Again, no other fees are listed. The notes clarify that audit fees include the main audit of the financial statements and related regulatory filings. The tax fees from PwC, however, are specifically for services provided to service affiliates of the fund. This is a key distinction. It is not for the fund itself, but for related companies. The big number here is that $682,400 in tax fees paid to PwC for service affiliates in 2025. This is a substantial amount, and it is important to understand what these service affiliates are. Usually, these are entities that help manage or administer the fund, and paying them for tax services is common, but the amount is notable. This sentence further explains that these non-audit fees paid to PwC were for services to the fund's investment advisor or entities closely related to it. So, while the fund is paying for these services, they are for the broader management ecosystem. The fact that this amount was zero in 2024 and jumps to over $680,000 in 2025 is the core of the correction in this filing. It seems the prior report had a zero there, and this amendment clarifies the actual spending. Diving into the financial statements themselves, the schedule of investments gives us a detailed look at what the fund owns. As of the 31st of October 2025, the fund held nearly 201 positions. The largest sector, as we saw before, is financials at 24.0%. Within financials, top holdings include JP Morgan Chase, Bank of America, Citigroup, Goldman Sachs, and Wells Fargo. This concentration in financials is a key characteristic of this fund's value-oriented strategy. The report lists large holdings in companies like Alphabet, Berkshire Hathaway, and ExxonMobil. The statement of assets and liabilities shows that the fund's total assets were about $135 million. The investments themselves were valued at nearly $134.9 million. Liabilities were quite small at just $666,000. This means the vast majority of the fund's value is its net assets, which stood at a healthy $134.4 million. For the institutional class shares, the net asset value was $15.28 per S-share. For the investor class shares, it was $15.11 per S-share. The statement of operations shows how the fund made and spent money. Total investment income was about $3.4 million, mostly from dividends. Expenses were $731,000. But importantly, they waived some investment advisory fees, reducing net expenses to $460,000, after accounting for investment gains and losses. The fund saw a net increase in net assets from operations of over $15.9 million. These statements track the bigger picture of how the fund's net assets changed. In 2025, besides the operational gains, there were significant distributions to shareholders, totaling over $17.4 million. There were also capital share transactions, meaning new shares were bought and existing shares were redeemed by investors. Overall, net assets decreased slightly by about $1.25 million in 2025, after a significant increase of nearly $40 million in 2024. The financial highlights put everything on a per-share basis for the institutional class in 2025. The net asset value at the start of the year was $15.49, and it ended at $15.28. The total return for the year was 12.99%. The expense ratio for institutional shares was 0.35% for the investor class. The net asset value started at $15.32 and ended at $15.11, with a total return of 12.75% and an expense ratio of 0.60%. These expense ratios are quite competitive. The notes to the financial statements provide important context and detail. They explain the fund's organization as a Massachusetts business trust and its investment objective, seeking long-term growth by investing in undervalued stocks. The valuation of securities uses a hierarchy, with Level 1 being quoted prices in active markets, Level 2 being observable inputs, and Level 3 being unobservable inputs. For this fund, as of the 31st of October, 2025, almost all its investments were valued at Level 1, meaning they had readily available market prices. They also detail their use of repurchase agreements for managing cash, with collateral generally exceeding the principal amount. This is a standard practice to manage short-term liquidity safely. This is the auditor's report. Ernst & Young LLP states that the financial statements present fairly, in all material respects, the financial position of the fund. This is a standard clean opinion confirming that the financial statements are reliable based on their audit. They also note they have audited investment companies managed by L.S.V.V.X Asset Management since 2005, indicating a long-standing relationship. This notice provides tax information for shareholders, detailing the breakdown of distributions into ordinary income and long-term capital gains. It shows that 78.28% of distributions were long-term capital gains for the year. The rest of the filing covers standard items like changes in accountants, proxy disclosures, and remuneration of directors. For this specific amendment, the key focus is the correction of the accountant fees, which is detailed under Item 4. The other sections largely state that they are not applicable or that there have been no changes. Finally, the report is signed by Michael Batty, Principal Executive Officer, and Andrew Metzger, Principal Financial Officer, on May 22, 2026, indicating the official filing date. Looking at this filing, the main takeaway is that it is a correction of a prior report. The financial performance of the L.S.V.V.X Conservative Value Equity Fund, while underperforming against a market heavily driven by growth stocks, has been solid over the long term, especially for a value-focused fund. The most significant detail is the correction of the PwC fees, particularly the large tax services paid to affiliates in 2025. While the fund itself did not directly pay this huge sum, it's part of the broader management structure's expenses which investors indirectly bear. The auditor's report provides a clean bill of health on the financial statements. My biggest concern is always understanding how these affiliate fees impact the overall value proposition for the investor. Even if indirectly, I'm actually looking for clarity on how these affiliate service fees translate to actual investor costs year over year. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord too.